Recording in progress.
A very good morning to all of you. A very good morning to all of you. I welcome you all to our today's session. It is a very important topic, that is future of foreign assets, foreign influence in the ideas. So we have a panel discussion today with three panelists and one moderator who are already here. Before we start the meeting, I would request you all to please stand at attention for the history of motor song. Then we proceed.
Yeshasuteshu Jagrati Yeshasuteshu Jagrati Tam 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 Sha Nirvimana Nirvimana Adeva Shukram Adeva Shukram Adeva
Please keep standing for the national anthem.
जनगणमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड़ उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगल दायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you. To introduce our panelists for today, I would like to invite CM Hardik Ji, CM Mehta, and CM Shakar Ji to take the introduction of all our panelists.
Good morning, everyone. Glad to see you all for Shop Sunday here. I am great pleasure for me to introduce today's one of the panelists, Mr. Mahesh Nayak, who is a chartered accountant having more than 11 years of experience in the field of international tax, business restructuring, domestic tax, transfer pricing, and FEMA. He is currently director in the tax and consulting practice of CMK and Associates LLP Mumbai. He has prior experience also as a manager in the direct tax practice of UI LLP. He has successfully completed advanced LLM in international tax from the International Tax Center, Netherlands. Mr. Mahesh is a regular speaker and he has led many group discussions on the international tax as well as domestic tax issues in various conferences and study circles organized by Professional Association, Study Circle, BCA, etc. He is also co-authored chapters in MLI Compendium and Transfer Pricing Compendium of the BCS and International Taxation Compendium of CTC, and he is also co-authored the publication on disclosure of foreign assets and incomes and analysis by the BCS. He is also co-authored for the international tax column in the BCA journal. Friends, in this short introduction, I welcome Mr. Mahesh Nayak. Please welcome with the round of applause. Now I invite Mr. Mahesh to introduce the next faculty.
Very good morning. I'm pleased to introduce today's moderator. Everything depends on moderator और कैसे moderate कर रहे हैं, speaker से क्या-क्या उनकी खूबियां बाहर निकालनी है. So, CA Hardik Mehta has over 14 years of experience and specializes in advising clients on exchange control law, that is on FEMA and international tax laws. He also regularly represents clients before RBI, income tax authorities. He has appeared before the CIT, DRP dispute resolution panel, etc. Pricing in other income tax matters, he is also advises on assisting NRIs, subsidiaries, Indian companies with USA in filing US tax returns. He is associated with MB Nayak and Company Chartered Accountants over a decade. He has co-authored the publication FEMA Compounding Orders, a comprehensive analysis published by Bloomsbury India in July 2019, and FEMA Compounding Order, a comprehensive analysis, volume 2. He is regularly speaking on the BCS, ICI, NIRC, SIRC, SIRC, on FEMA compliances and other international taxation matters. Please welcome CA Hardik Mehta. CA Rutvik Sanghi was kind enough to make his entry at the last moment. We thank for him. And he is having the more than 18 years of experience. He is practicing in the international tax and FEMA. He is a partner in Rashmin Sangvi and Associates. Please welcome Rutvik.
Well.
Now, today we have to introduce 3 people because our speakers are at large.
Yeah. Thank you, Mahesh. Good morning, all. Thanks to JB Nagar and Karmena for giving me this opportunity, and really today I am proud while introducing one of the panelists, who is none other than my partner in profession also. So, to introduce one of the panelists, C. Kartik Badiani. Kartik is the commerce graduate from the Mehta College, and he's also completed his LLB from the University of Mumbai. He worked with the KPMG initially and has advised multinational and domestic clients on Indian and international tax in the foreign exchange issues. He has significant experience in advising the clients in the area of the corporate tax, international taxation, inbound investment structuring, establishment of the joint ventures, business reorganizations, tax due diligence, etc. He has also advised the various private equity players in setting up their funds, structuring the transactions, investments contemplated by these funds in India from the tax and the regulatory perspective. So the profile is little bit more, but I'm just reading whatever the relevant important parts are there. So just to cut short his profile. Thank you, Kartik Bhai, for being with us on Sunday morning for valuable time. We welcome JB Nagar CPA Circle with a round of applause. So now we'll present the moment to each of the panelists and moderators.
I would like to inform you all that our second speaker is already here. He's kind enough to be here for the first session as well. So ask him.
Hello. Very good morning. Thank you, JP, and the CD Study Center for having us here. Since we have, I think, short on time now, we have time till 10:45. So without, self practice, as like, my job is to make sure that we extend as much as knowledge from all these three panelists here. And, it is a fruitful Sunday morning. So, before going into it, why this topic? And of course, the relevance, we just finished our tax filing season with respect to individuals and non-qualified, but now we have companies and others. So the origin has started, basically, if you all read, newspapers, foreign media, lot of tax evasion, leaks, Panama Papers, Pandora, various leaks were happening, HSBC thing. And one of the major point which every government in the world, especially the developed countries, was of the opinion that somehow where there are high taxes, which are known as STJ, high tax jurisdictions, people or the entities from that jurisdictions are, making their wealth park outside that country. And the taxes are being evaded. That is one of the question, and even the disclosure is not there. And you must have heard various I would say hearings which has happened in US, where even the UK, which was very live stream, the Starbucks, and how they were grilled and then they went out and paid the ad hoc taxes. The point was not only tax evasion, the point was also the structures which were in place to keep all these foreign assets or this income outside and park in tax havens. So the whole history started with 2010, which we largely known as FATCA. So as I always say, US is a brainchild of everything. Whether it is tax litigation, tax legislation, for anything in the world. Yeah, for that. You never know. Even I didn't know that in US itself there are taxes. Okay, and there are jurisdictions because it is of 50 states, but various states have their own policies. Let's take US as a separate topic today. But the point was the FATCA was the first step towards at least getting the information. Now, being a bully, I always say he was a bully, right? Because it's one of the countries which actually enforces the law on other countries, whether it is financial institutions or. And because of that, most of the FI, which is the financial institutions, were compliant with sharing of data under the FATCA regime. Today, even most of you, even if you have one of the NRI client, right, you will get a query. Bank has asked this FATCA declaration. But this was with that aspect. After that, world over, most of the countries, whether it is G20 or OECD or even, everyone felt that there has to be some common reporting standards, and that's where we have CRS and automatic exchange of information. Took place. The legislation took place, and it was a multilateral instrument which was signed by 110 jurisdictions. I always give an example here. And some few years back, and I think most of my panelists will agree with this. We had one of the case where assessing was asked by the IPO. The investment was in Mauritius. Can you please provide this information? And the client said, please give me 1 week. I'll come back with the information which you are required. It was somewhere around 11:30 in the morning. And I remember this because I was listening. 3:30, 4 o'clock is received. Sir, information आ गई मेरे पास. आप आ जाओ शाम को. So this was a swiftness in which the information was received by the department. And that's where, this is where I would like to say that how automatic exchange of information takes place. Now, where Indian perspective, let's understand from Indian perspective, because we are today at FA schedule. Largely we are concentrating on FA schedule, how the reporting of foreign assets takes place. So I started with FI 11. It is just a disclosure schedule. It got not many line items added. It got modified many times, I would say, at least few times what I know. And it doesn't have a teeth, I would say, any penalty per se in the Income Tax Act. But the major enforcement, I would say, litigation or the penalty or the kind of, you can say, it is used this schedule much more important than you must have seen. I think roughly around 16th of July or 17th of July, there was a half a page ad in economic analysis, the major news papers that please report your foreign assets, otherwise you will be liable to penalty. And that's where VMA takes in. Black Money Act, which generally known as. It was introduced in 2015. Section 43 deals with it. For more, I would ask Kartik, because most of these panelists have handled such cases. Please give how this Black Money Act makes this officially more dangerous if you don't report, and what is the fallout of this?
Thanks, Hardik. So, as Hardik rightly said, there is no penal provision for non-disclosure of foreign assets under Income Tax Act, but Section 42, 43 of Black Money Act does cover it. Black Money Act predominantly was actually introduced to unearth the undisclosed foreign asset as defined under the Act, which is basically for which you can't prove the source and are actually totally undisclosed in terms of it does not have a right source of income or an explainable source of income out of which the assets were acquired. However, it has an additional penal provision for not even mentioning what foreign assets you hold in your tax returns under Schedule FA, which is a flat penalty of 10 lakhs. Because there is no penalty under the Income Tax Act, till the time the Black Money Act was invoked, from 2012, so FA schedule is in the ITR from 2012-13 onwards, but from 12-13 to 2015, there was no penalty at all, which is when nobody even realized that there is an FA schedule in the ITR form and nobody was ideally filling it up. Right? But from 2015 onwards, now we are of late seeing notices as well, where cases have been picked up, there is a penalty which is invoked at a lower level, right? And ultimately we have as many as I think 4 judgments from ITAT where that 10 lakhs penalty has been reversed on some or the other count. We can discuss more when we are picking up that specific schedule on how to deal with such kind of situations. Over back to Bharat.
So thanks, Kartik, and I think he will also give you some perspective of the recent, new students on the same. As I told you, the schedule got expanded over the years. And we will also deal it in detail when we come how under section 139(1), read with rules and the instructions, one need to report, who needs to report. There are some basic questions which we will discuss, and of course, then we can have at the end a Q&A session. But before going that, there are two things which is very important, that if you don't have any income, but you have finance, then what to do? Under the Act, there is a mandatory filing for the same. Also, there are two provisos. I am not going into total technical stuff, but there are two provisos which deals about beneficiary and beneficial owner. Before going ahead, I would just like Ludwig to just explain these two terms, because this is something which is very important. Because today, we generally go, who is a beneficial? There is also some concept of UBO, right? And such, terms actually confuse people. You might ask your, article or your office staff, because this is a client, please prepare the return, and you get the details of foreign assets. Now, he will just, without any, impression of the act, how it is, just will send a mail to the client. Please give us all your foreign bank accounts, all your foreign assets. Now, what a layman would say, okay, I don't hold anything in my name. Okay. So where this, beneficial owner, beneficiary kicks in, just a, brief, Ludwig, it would be great if you can just share your thoughts on this.
Thank you, Hardik, and thank you everyone, and especially the organizers for letting me come in at the last minute. I'm sorry, I had some other engagement, therefore I had to perform at the very last minute. I think there is a particular slide which we have captured the differences in the definition. So let us come to what Hardik is trying to explain here is that why we have a requirement for disclosure of foreign assets. Who is supposed to disclose that? Obviously, it is the beneficial owner who is supposed to disclose. So now coming to the disclosure requirement, which Hardik explained, is not linked to your income. Let us be very, very clear about it. What it talks about is that as long as you have a foreign asset outside India and you are the beneficial owner of such foreign asset, you are supposed to file the tax return even if your total income is nil. There are very few exceptions. I think there's only one exception to that rule where there's clubbing provisions which apply. But other than that, if you, and this is typically taking, I'm not sure if that example will come later, but let us say there's a student who's gone out of India. That student has opened a bank account naturally in the country in which he is studying. Now, that bank account, in the year when he leaves India, he is still a resident of India, and which means that when the student is a resident of India and has a foreign asset outside India, he is supposed to disclose that foreign asset in his tax return. And that gets missed out in general because you never think that student probably has no income because even in the bank account has been opened only for the purpose of his expenses where he is staying. So even in those situations, you are supposed to disclose. Unfortunately, we have different definitions when it comes to beneficial owner itself, and that is what is probably brought up in this slide here, where we have explanation 5 to section 139(1), which talks about beneficiary, then the instructions to the ITR forms, and then the explanation to Rule 114F. Now, 114F, the whole set of those rules have been brought in so that those who are supposed to disclose under the PETCA agreement, they would know that what is to be disclosed and who is to disclose, generally speaking, the financial institutions, and for them there is a definition also. So now we have 3 sets of definitions, which to look at, which not to look at. I would put it this way, in a very practical basis, let's not go into the nuances and those technicalities here. The fact of the matter is that as long as a resident of India is a beneficiary of a foreign asset, that person should ideally disclose the tax, should disclose the foreign asset in his or her tax return. Now, you may ask, okay, who is the beneficiary, who is not? Ideally speaking, every beneficiary knows whether he is or he is not. Now, if say, for example, there are issues of joint holding, which we will cover, I believe, later on. There are issues where a person may not even be aware in cases of a trust that, okay, whether he is a beneficiary or not. I think the simple dictum which can be followed is that if that person in India who is a resident has given his or her KYC details for that particular foreign asset, which includes, generally speaking, the Indian passport. Invariably, it seems that the information is coming back to the Foreign Asset Intelligence Unit in India, which means that they have record that, okay, so and so Indian citizen has opened a foreign asset outside India. Then whether the person is a resident or non-resident comes into play, and then if the person is a resident, then whether he has disclosed those assets in India or not. So largely speaking, I would put it this way, that a broad principle which can be followed, apart from the technical details which are given in the Act, is that if the person has an Indian passport disclosed to the foreign authorities, to those foreign financial institutions, which typically happens even as soon as you open a bank account or open any kind of an asset, they will generally ask you to disclose it. So in that sense, you should ideally have that as a rule that yes, you please ask your client that, okay, please disclose this foreign asset. Foreign assets, as probably it will be brought up later, I'll just put it in a small point, is that foreign assets is not linked to your balance sheet. It is not. Let us not go into that, confusion that, okay, I have to match my balance sheet with it. You only have to explain why you have disclosed, and more importantly, you have to explain why you are not disclosed, but there is overhang of the penalty. And therefore, it's better to disclose and not stick to the fact that, okay, I may not be putting it in my balance sheet. It is not linked to your net worth. So I'll just stop here. Kartik, is it okay?
Yes, yes.
So I'll just make an additional point here. I think legal owner definitely has to disclose. Beneficial owner is something who also has to disclose. If the section clearly says beneficial owner or otherwise. Correct. Second is explanation 5 to 139(1) that you're seeing is the condition for the purpose of filing the return. Even if you may not have a 2,50,000 income, you may not be otherwise liable to file a tax return. Proviso 5 specifically requires you to file the return if you are holding a foreign asset as a beneficiary or otherwise. And the definition that you see is with respect to that provision. Once you are liable to file the return, you go to the form for interpreting the form or to get guidance on the form, you go to instructions to ITR forms, which has more or less a similar definition, which is at the center of the screen right now. And then explanation to rule 114F1C is more with respect to beneficiary of a trust, correct? Which is, as Rudwin rightly explained, it is more from a perspective that a reportable financial institution being a trust in India, how does it cover or interpret the term beneficiary of a trust, and how does the reporting happen in that market?
Just one point I want to add is that so there is a slight difference in the definition of beneficiary. If you see, and I think the slide also is trying to bring that out in the explanation to section 139 and instructions to the ITR forms. The difference being that in the explanation to section 139, which Kartik mentioned, that it is if you are a beneficiary of foreign assets, even though you do not have any income which is exceeding the maximum amount not chargeable tax, then you are required to file a return. That's why they're explaining what is beneficiary. So they're saying that if you are deriving any benefit during the previous year. Now, vis-a-vis, if you see the instructions to the ITR form, it talks about any immediate or future benefit. So let's take a situation where you are a beneficiary in a trust or just of an asset, and you have not received any benefit during the year. The question is, do you have to disclose it? And I think if one sees the way the foreign assets, and I think I'm sure the panelists as well as the moderator, all of them pointed again will bring out the same issue that the way it has been brought in, the way it is structured, there are no proper instructions that are given, and there is no while we understand that there's some underlying logic behind introducing this, but there is no matching that is provided. Or where is the information coming from? So there's no reasoning that is there, and which sort of there are a lot of issues that come up as to do I disclose, do I not disclose? Obviously, as a tax advisor, you always advise the client that it's always advisable to disclose if you are in two doubts. But in such situations, it arises that do the instructions go over and above what the section is saying in terms of definition? Because if I have not received any benefit during the year, under explanation 5 to section 139, which talks about beneficiary of an asset, although for filing a return, it says if you have not received benefit during the year, even though you are a beneficiary of an asset, don't file the return. But the moment you come there to instructions, it says irrespective of whether you are receiving the benefit this year, even if you are going to receive the benefit in the future, you should be. So the question is, what's the legal sanctity of the instruction? Then again, another aspect is this instruction, if you see, so obviously schedule FA has been there from FY 11-12, that is AY 12-13. Till AY 16-17, the definition of beneficiary was pretty much the same in the act and the instruction. And it was only in AY 17-18 in the instruction there was a change. So again, how does one really keep track, and what is the legal sanctity of the instruction? So that I think is something, there is a lot of aspects where one is confused. And how do you, even one is talking about FATCA. Now, obviously, a lot of times the way the schedule FA is that you will refer to a lot of terms, you don't understand what are those terms. So you may possibly, yes, one will say, okay, the underlying is possibly FATCA, and one will go there. But there's no instruction by the income tax department saying that, this is where you need to go for to understand these terms. Because again, rule 114F, which Rutvik alluded to, is for FATCA. It is not for taxpayers. It's for financial institutions reporting the, foreign accounts, the foreign financial accounts. So where does one really, in the absence of these instructions, how does one really tackle it?
I think just to add the importance of these nuances is that when you are faced with a litigation, what I mentioned about it was on a more practical basis when you are advising your client about what to report or not to report. Against that comes the fact that the person is probably not reported. And then there comes a litigation against the penalty, which is a flat 10 lakh rupees. So you are looking at the litigation terms, and these nuances actually help out because there was confusion even probably in the department stage when they were not clear about what has to be done and what not has to be done. And therefore, the importance of whether the instructions can even override the act. So these points, I think, from that angle, and we'll see more and more because there are quite a few decisions which are already out, and we'll see probably more and more happening. We have 14 foreign asset intelligence units across the country made for only this purpose to hunt for those people who are, because they've got huge amount of data right now and they themselves are not able to actually comprehend. So they have put as artificial intelligence and filters and whatnot to just see that, okay, which are the ones which are very large assets which are not being disclosed. But it's not that they are going to give up on the others. So they slowly and slowly you will see a lot of litigation coming up on these aspects. So back to you.
Thanks. I think beautifully explained one of the most important points by all three of you. And I think even if there is, not very much certainty, we have three of you, to explain us. So we are fine with that. But yes, going on, let's take to the next thing. We have understood the origin. We understood one of the important aspects as to who is liable to file. We also understood two of the more important definitions. But what is the objective of this? Of course, part of it was just discussed. But there is also a couple of more objectives apart from taxing is also the source. So in fact, day before yesterday, I had a talk with Kartik, what is source and what is source of truth, right? And we had a good brief discussion on the same. Let's not go to that, but what department wants? Department wants that if you are earning X income, or if you are getting X money in your account, what is the source of that income or money? Which asset you are doing? Many times, and this is where I would like to bring to your attention. Most people confuse, that there is a, the difference between residential status under FEMA and income tax act. Many times people feel that, if I am a non-resident under FEMA, because that is the first instance when you become a non-resident, because let's assume a person is going for employment. Under FEMA, you become non-resident from day one. And what is the first, if the person knows, otherwise if consultant will say, please convert your savings bank account into an NRO account. But you must have moved out of India in January 23. What under income tax act, he would be our account. Assuming he went for the first time. Now, he must have even after going there, whether that has to be disclosed. Absolutely yes, as a R or official must. It can happen the other way around. When you are coming back to India, right? And that's where I think the objective is not only capturing your incomes, is also your assets, which might be built while living in India. So as a resident, when you remit money, you of course do LRS declaration, you give Form A2. But there might be some assets which must have, been made, although when you were outside India.
or that when you departed from India. Also, you must have heard many people get gifts from when they are non-resident or from NRIs. Now, how to capture that? How to how government has data of that? This is one of. You will also see couple of case studies. One of the case studies is on ESOP. How ESOP need to be restored. All these things are not the assets which are made from money remitted from India. There are two kinds of how you can make assets outside India. Also, the bottom line principle, what I understand, and I will then ask all the panelists to open on that. What if, and this is where I think we would have scheduled to cover this in later slide, but I would like all of you to open on this. What is the precaution which every assessee and a consultant should take? I remember when this was introduced for the first time, we never used to take an MRS from an individual. Never, right? We used to just look at that, what bank statement there. He would not be hiding anything from us, right? Of course, he has opened our eyes are far wider open. But even with respect to that, foreign assets, when this came and when we understood after 2015 that penalty of 10 lakhs, we started obtaining an MRL from individual banks. Please give us a declaration that you don't own a foreign asset, you don't have any financial interest in any entity, you are not a signatory in any of the bank accounts of any entity, you are not a beneficiary of blah blah blah. What if I have to disclose and I don't disclose? What if I disclose at one place after assets and liabilities schedule, and even currently our income tax form is far from Sabal and Sahaj, right? With 100 plus pages, you cannot say it's a Sabal form, or it's a third form, or even it's a very easy to file it. Normal income group are not able to file. But what if I disclose at one place and don't disclose at another place? What if I disclose in my assets and liabilities and forget to disclose in my FHLU? What if I have a bank? I don't have personal bank account, but I am a signatory to a bank account of a foreign subsidiary. I have disclosed my investment in the foreign subsidiary in FHLU. If I forgot to disclose one of the bank account because it was open and I was just one of the directors. There are 3 other directors. I was not aware. So what happens in such cases? One is a fallout. And secondly, if there is enough documentary evidence to prove my, it was not out of negligence, it was not out of intentional error. And I can prove that in some or the other way I have disclosed this. Ultimately, government wants to know what are your foreign assets. And income comes afterwards. There has to be a source to generate it. So if one by one, if all 3 of you can just build on this, that what is your views on the documentation? And also, what if there is a follow, whether device returns can help, whether updated return can help. I think this is something which would be much for the audience here.
So friends, as we started, section 43 of BMS is 10 lakhs flat penalty with a small exception of bank accounts. Again, that does not really allow you to not report it. It's just that the penalty does not apply if the threshold is not met, the peak balance of the bank account is not met. But because there is a rigorous penalty of flat 10 lakhs, there is a case of being extra conservative or extra prepared in terms. And so first thing is, Hardik said that what precautions should be taken at the time of filing the returns, at the time of asking details from the clients. We can try and build in as detailed checklist as possible. But trust me, we chartered accountants are failing to interpret some of the requirements of reporting. If we write to the client is not going to understand what is to be reported, what is not to be reported. So keep it as wide as possible, as simple as possible when you ask for details from the client, and invariably it will happen that they will provide you one detail out of it to the company and there is one then the other. And therefore, there might be requirement list that you might have to send, and therefore, especially in case of clients who are very frequently using the LRS limits or who are staying abroad but are ROR because of their stay in India or something like that, who have assets abroad, please plan in advance, ask for the details in advance, otherwise you will fail to miss the deadline in terms of reporting the foreign asset schedule. Section return file under 139(1) can cover the disclosure. If you miss there, return file under 139(4) and 5 revised return, late return, both can cover FA disclosures, FA schedule disclosure, then penalty will not be levied if you are reporting foreign assets correctly in either of these three returns. However, 139(8), which is updated return 8A, I think is updated return, that is clearly not covered under section 43A exclusions. And therefore, if you are updating your return, paying extra tax and disclosing foreign asset schedule very technically, does not have an exemption from the 10 lakh penalty under section 43 of BNA. It seems to be a miss. Representations can be made because if you are allowing under 139(5), why not 139(8)? But as of now, as the law stands today, there is no exclusion or exemption. Coming to, I think, any other point on this you can add, otherwise I'll go to the litigation. So coming to litigation, what happens if you have missed, if there is a mismatch which can be explained, correct, courts will help you. Because anyway, this 10 lakh penalty, people believe that it's onerous, correct, it's very harsh for genuine cases where you have actually, there is no intent, the asset is acquired out of explained source, and there is no real intention or mens rea behind not disclosing the same. There have been cases where it has been disclosed in various parts of balance sheet. So, for example, a company, a corporate entity, a very recent judgment of our own client came in a week back on 30th August, where there was a company who had set up a subsidiary under ODI. ODI filings were made with RBI. It's regularly reported in annual reports under the related party disclosures. The total of investments have also gone in the balance sheet, which was attached to the tax audit report. It's also gone in the ITR BS schedule, but it was not reported in the FA schedule. Correct. The decision is in favor, saying that section 43 of BMA, which is a penal provision, needs to be interpreted and invoked judiciously. It cannot be invoked in all the possible cases. Correct. The AO has a right and the discretion to invoke it, but he has to invoke it judiciously, and therefore, at tribunal level, you are getting relief. There was Leena Gandhi Tiwari, there is this new judgment which has come on 30th August. Now there will be a flurry of cases at various tribunal levels which will get this benefit. But a point of again representation as to does an assessee for such kind of cases where it has been reported to various authorities in the ROC, in the ITR form as a total of the investments. Do you really need to travel all the way to ITAT? Is the question which we need to ask. Maybe a representation can be made. The genuine cases, you should allow the EO itself should be taking a call rather than sending it all the way to ITAT. I think other panelists can add.
Yeah, so I think I agree with Kartik. Definitely, I think the ITAT judgments, etc., do find that that the fact that you have disclosed it in, because again, your Black Money Act section 43 does not specify where it has to be disclosed in the return. It talks about just disclosure in the return. So it does not say disclosure in the schedule FA of the return. But that being said, obviously, practically the very fact that it went to the ITAT is because at the ground level, the assessing officer is saying, and where is it coming from? So again, Kartik alluded to that FATCA, CRS, they are the exchange of information. So the officers are getting the information that there are foreign assets. They look at the schedule FA, they see there's a mismatch, or they see that it's not disclosed, and you're going to get a notice. So and I think a lot of clients have got notices in the last year, a couple of years. So I think yes, so yes, you will be able to explain it that okay, you have put it in schedule AL or in your balance sheet, etc. So that will help at least from legal consequence. But again, subject to litigation, because at the ground level, I think I'm not sure the assessing officer is going to agree to it. But so therefore, as an advisor, as a consultant, always advise that better to disclose, even if you have disclosed it in AL, even if you have disclosed the bank account in your schedule bank accounts, or whatever it may be, it is better that you disclose the asset in schedule FA as well, just so that you don't have to have the headache of going and explaining it to the officer. Of course, there are a lot of areas where there can be mismatch in terms of exchange rate, etc. But at least you have disclosed it in schedule FA, so the starting point itself becomes easier to explain to the officer that see, I have disclosed it. And therefore, the whole issue of litigation does not arise. And again, just one point in terms of disclosure, yes, I think, the MRL does help, at least getting to the client, getting the information from the client. But again, harping on the point that the way some of the terms are, right? You cannot ask the client, do you have a depository account? He'll be like, what do you mean? What is depository account, right? And so what? And therefore, those are aspects that I think one will need to break down, one will need to have examples and explain to the client that do you have these kind of assets? Because obviously you cannot expect the client to go and read what is the guidance code of FATCA saying, or what are the income tax rules saying on this, what is to be disclosed. So therefore, I think it's very important. And again, just one small aspect on the bank account should, depository. There are sometimes you have these multi-currency accounts, which if they're part of the same account, that's fine. But if it is considered a separate account in itself, then it is always advisable that you disclose it, separately, just so that the whole idea is to also one is obviously penal consequences. Secondly, also to be able to explain to the officer, and the chances of receiving a notice is less because there's no mismatch, because that's how the bank is going to, the foreign bank is going to report to its tax officers, and where how income tax would also be getting this information.
I think both Kartik and Mahesh have covered it very well. I'll just put it this way, that what Hardik's question was that, okay, what do we as CAs do? I think the point blank is that when you set a reminder for the tax return filing, just ask them that do you have a foreign asset? Start with that itself. And then whatever answer comes, analyze it at your end. Don't leave it to the client who say that, okay, what type of assets are to be disclosed or not to be disclosed. The fact is, as what Mahesh also just mentioned, what is depository, what is custodial account, whether you have to disclose or not. Be mindful of the fact that the exemption, as Kartik pointed out, is only for bank accounts, and that also only up to rupees finance, hardly $6,000. You will come to know that there are so many other assets which the client may have missed out in reporting because they feel that that is not required. A live case which we had from a client, from a CA, was that the fact that the person was a banker with 20-year career, with which 15 years he was out of India. He had 25 bank accounts, out of which he disclosed 16. But 9 of them, considering that they are dormant, why should he disclose? He did not. And then the fact that the officer will say that, all said and done, I know that this is not out of your, unearned income, this is not your black money, but my hands are tied. This is the refrain from every tax officer when you go and meet them. The penalty always has to be commensurate with the violation. Unfortunately, this penalty is acting like a fee. They are straight away telling you that we have only discretion of either 0 or 10 lakh rupees. And obviously, nobody is going to give you a 0 penalty because they are saying that no, we'll have to answer the higher ups. So straight away go to 10 lakh rupees penalty, fight it out till the tribunal because you will not get relief till then. So these are the sum and substance of the practical issues which a person faces, and therefore tell your client along with the reminder, if you have a foreign asset, please let me know, and we will sit across the table and see that, okay, how to disclose, what to disclose, what not to disclose.
Thanks. I think that gives that makes foundation, both objectives, principles, and origin strong. Now we will do a rapid Q&A, right, with all 3 of them. And I think this is where I think most of the common queries we will try to answer. And if anything we can, of course, the floor can be open for more Q&A. Kartik, whether a non-resident or an RNO need to disclose everything, and we can take with that what happens if there is a change of residential status, and whether all citizens needs to be disclosed.
So, a non-resident or RNO, or not ordinary resident, does not require to make a disclosure in foreign asset schedule. It's only a resident and ordinary resident who is required to make a disclosure in foreign asset schedule. What happens in case of change of residential status? Change of residential status, say for example, I think we discussed one example where somebody is going outside India for employment during the current year. But you continue, if you are say going in the later half of the year, you continue to be a resident and ordinary resident for that particular year. Please note you need to make the disclosure even if you moved out for employment. Similarly, if somebody is come back to India for good and is not covered by the exceptions under Section 6.6, and therefore he is a resident and ordinarily resident for that financial year, he needs to start disclosing the foreign asset in the ITR from the year in which he turns ROR. Right? In case of foreign citizen, ideally all residents but all ordinary resident as a thumb rule are required to make a disclosure under foreign asset. However, though not under the Act, but under the form, there is a specific note which is provided. If you see right at the bottom of the FA schedule, it says please refer to instructions for filling out this schedule in case of an individual not being an Indian citizen, so a foreign citizen, who is in India on a business, employment, or student visa, and because of which, because of his stay, he becomes an ordinary resident. An asset acquired during any previous year in which he was a non-resident is not mandatory to be reported in this schedule if no income is derived from that asset during the current previous year. Lot of conditions: you need to be foreign citizen, you need to be either on a business, employment, or student visa. The asset should have been acquired when he was a non-resident, and no income from that asset derived during the year. If all these conditions are satisfied, then you don't need to report foreign asset as a foreign citizen. Otherwise, even as a foreign citizen, if you are resident and ordinary resident during the year, you need to make a disclosure of foreign asset.
In fact, with this, I had a client. I just remember. I just thought everything is linked to your signature status. Many times, clients are not aware, or they don't inform. I can give benefit of doubt to each one of them. And I had one of the cases that client had become a non-resident but was continuing filing return as resident. And in that case, he was not disputed. But in the first instance, if there is a AO, right? If you just say that you are filed return as a resident, you are not disclosed your foreign assets, I will tell you. So you have to then revise your return, you have to make, and even I had the different cases when client comes to India, right? And but for some other reason, the first year it files as a non-resident or RNO. Generally, for first 2 years is fine. But even after that, sometimes I've seen people continue to get RNO, right? That doesn't dissolve you from your non-reporting, because when you do in your software, now most of the charter accountants, rely on the software. If you write RNOR or a non-resident, the software will never give you a pop-up that you are not disclosed the foreign asset. Only if you change to R1, then only you get a pop-up. Unless you do manual return or manual utility, this might be one of the downsides. Now going to the further, Kartik, what so and this is why I think it is very important to know that this doesn't you would have never imagined such situations, but whether minor needs to disclose that. And let me give you an example which he can answer. What if now most of the students and youngsters move out for studies at the age of 14 and 16, right? Earlier we used to go after 12, no, after 18 or something. And what happens if they go for studies and they open a foreign bank account, and that year they are ROR? First of all, whether they can disclose, if not, then who can disclose?
So when it comes to minor, I think there could be 3 possible situations. One situation could be that minor is earning some income, not your example, but minor is earning some income out of his own skill sets, because of which he is anyways otherwise liable to file a tax return. Second case could be that a minor is earning income, but it is to be clubbed with his parents, correct? And he does not have any income on its own. The third situation could be where minor does not have any income and is only owning a foreign asset. So there is a foreign asset which a minor is a legal owner of, correct? And if you see explanation 4 to 139.1, so explanation 4 to 139.1, that says, provided also that a person being a resident other than not ordinarily resident in India, so minor is a ROR within the meaning of 6.6, who is not required to furnish a return under this subsection, and who at the time during any time during the previous year holds as a beneficial owner or otherwise any asset, including financial interest in entity located outside India, or has seeking authority in any account outside India, or a beneficiary of any asset located outside. So if a minor is holding a foreign asset and he is not liable to file return in India, then still he is required to comply with Proviso 4. Now there is an exclusion under Proviso 5, and how does it change the things? It says, provided also that nothing contained in 4 provisos shall apply to an individual being a beneficiary of an asset, including any financial interest in any entity located outside India, where income, if any, arising from such asset is includable in the income of the person referred to in clause A of that proviso in accordance with the provisions of this act. So case 1, where I have an income of my own skill set as a minor, which is more than 2,50,000 rupees, I am anyways liable to file the return, correct? And therefore, I will report for an asset in my income. Case 2, where I have income from the foreign asset itself, but it is included in my father's return. Then the 4th proviso is not applicable because of 5th proviso exclusion, and therefore I will not file a return even though I hold a foreign asset, correct? But my father will include the disclosures in his return, correct? Last point is where there is a problem, where I don't have any income out of the foreign asset at all. There is only a foreign asset where I don't get a help from the 5th proviso because the income is not included in my father's return because I don't income in the government. And therefore, what happens? So minor again does not get the benefit of 5th proviso. Under 4th proviso, minor have to file a return. But there could be a technical difficulty where the system, the form itself will not allow you. And I think I'll ask Rutwik to share a practical experience on the same. The form itself will not allow you to file a return.
Yeah, so we had a situation of what I alluded to earlier about a minor who leaves India for purpose of studies, has a bank account outside India, has no income in a sense where even being a resident in the first year, has no income whereby they need to file the tax return in India. Because there is no income, the parent also is not including any income of the minor in his or her tax return, which means that there is nothing which is getting clubbed. So you are saying that your 4th proviso technically applies, whereby it says that you have to, as a minor being a resident of India holding a foreign asset outside India, you are required to file a tax return. However, the 5th proviso, the exception to that rule does not apply because you have no income which is getting included into the parent sentence. So what happens then? So that is where we attempted to file the tax return because we are aware that unnecessarily there will be an issue later on because there will be a exchange of information where the minor's passport has already been given for opening the bank account. So we knew that let us better disclose it. Unfortunately, the system does not allow you until and unless the minor has his or her own income to which Kartik referred. So you are in a catch-22 situation. You want to disclose, but you're not able to file the tax return to disclose it. Which is when I had some interactions with the commissioner systems at that time, who mentioned that no, you don't need to. The 5th proviso is, for that purpose. So you include that asset into the hands of the parent. So I said, there are two things which come out of this. One, obviously, that there is no clubbing provision being applicable. So technically, how do I go ahead and disclose? Still fine, let me disclose it with the parent's taxes for that matter. The other is that information will anyways come in the name of the minor. The department will get that information, they will see your minor is not filed the tax return. So I told that, ideally you come out with a circular and explain that this is how it has to be done so that people are all clear and it's not just my query. There are already 3-4 other queries in CS and asked me about it. So I'm sure that there is in general a query like this. Unfortunately, no clarification and probably a few months down the line, I think probably in January or March 2023, we had cases where several minors were issued notices. And they were asked, okay, why have you not disclosed the foreign asset? So this was something which was there in the face of it that you should be able to disclose, but you are not able to because of the system. I think so. There, if at all, if you would wish to be on a cautionary side, one is obviously that the parent discloses. Second, if such notice comes, you have to explain that how you are not able to even file the tax return and how will you even disclose. I think these are the two stands which can be taken. Somebody who may want to, out of abundant caution, just inform it to the tax officer concerned of the minor that okay, this is what we are not by just way of a letter, there is no other way, but that does not, frankly speaking, technically help it, but at least you are very clear that there was something to be disclosed, but we are not able to. But by far, I believe those notices have been squashed in the sense that there is no follow-up action to my understanding taken up unless somebody has another experience from here. But largely speaking, they have accepted the fact that okay, the parent has disclosed that the minor may not, then it's all right.
Thanks, Hardik and Kartik.
I had one of the very interesting cases. Of course, I'm not going to ask that question to you. It's actually if time permitting again. So there was this minor because of online gaming. He was 16 years old, and of course, it was referred to by through another scene. And he won some game championship, and he was trading cryptos outside India. So the father of the minor was blasted the minor. Said, why did you do that? So he said, is gaming is bad for him. Gaming is not bad, is bad. And that will be bad. So of course we can discuss the data, how to report all those things. But yes, now come to a very a common issue. Where most of the, I think that's where I think India is progressing. Being a developing and slowly moving to earning a high middle working countries. Most of the people have this intention of buying properties overseas. And that's where I think you must have all had clients where people go to Dubai, Singapore, and they buy properties. And at the same time, with keeping all the competition, they always have second holder. Now the person might be disclosing, a person might become another afterwards, but have a second holder in terms of mother, wife, father in India. What happens in such case? Technically, state of convenience, right? Whether the mother is a beneficial owner of that property and has to be sold as a, this is one question which is faced by many. So Kartik, if you can.
Firstly, on your point on the cryptocurrencies, virtual, the question really is whether it is an asset. So income tax has at least recognized it as an asset now by getting in the VDA definition. So from an India Income Tax Act perspective, you would certainly have to treat it as an asset. But where is the location of that asset? Is it on the server where it is lying? Is it in the wallet where it is lying? Is it where the resident is located? Is it where it is born? Are all questions which are to be answered. In fact, OECD has come up with a paper amendment as well as explanations of 126 pages, I think, on this whole topic. Correct. So it's probably a subject in itself for a discussion. Maybe we can consider it for another session. But yeah, very, very involved topic. OECD is trying to work on what should be reported in terms of VDAs, virtual digital assets by cross country in the FATCA CRS deadline, where they have come up with a 120-page paper, which is again a draft. Yeah. So coming to this specific query on NRI son or any case where basically there are joint owners, but one of the person is the full owner, the economic owner of the property, whereas the second person's name is only added for the convenience sake. The second person also is a legal owner on the face of it by all property records, by everything. Whenever detail comes in from the overseas jurisdiction, either under FATCA or CRS, the detail will flow to the tax department. You will receive a notice, and even otherwise, if we read the language of Code Proviso to 139(1), it says reporting as tax return has to be filed by beneficial owner or otherwise. It includes the legal owner as well. Even the instructions to FA schedule ITR form are very clear that a beneficial as well as a legal owner both have to report it. So 100% the mother in this particular example will have to make a reporting of the foreign asset because she's a legal owner. Though she might not report entire income out of, let's say for example, the property is let out and there is a rental income, and entire rental income can be offered by the son. But it's okay if she is not reporting the rental income, but the asset has to be reported.
So just one, change or one change in fact, and can have some different consequence. We're talking about an immobile property. Now, immobile property is in, in a separate schedule in by itself in Schedule FA. But let's look at the situation of a joint account, bank account, foreign bank account where there is a joint ownership, and it may happen that the fund of only one of the holder is, moving into their account. So for tax purposes, etc., all the income is being offered in the hands of only say person A, and person B only for the sake of convenience is the joint account holder. So there the question is, so obviously the concept is same that both of them need to disclose the account, the asset in itself. For the purpose of the Immovable property talks about income. So the schedule for immovable property for foreign assets, it talks about income, amount earned and income that is offered in the return. So there's a separate and in which schedule is set. So therefore it talks about income. Vis-a-vis in your foreign bank account, your depository accounts, which is table A. So if from table A1 to table A4, if you see the schedule A, it does not refer to income anywhere. It talks about gross receipts received or gross amounts received. So it doesn't refer to the income by itself. And therefore, there, if you're a joint account holder, possibly the amount of credits that are received in the account, you may need to disclose that, because for depository account, it is gross interest received. So you may need to disclose the interest that is received, irrespective of, because, of course, this is all, our view, because, it's just something, there is no, possibly A1 to A4, because it does not, if you see the way table A1 to A4 is versus table B to G. Table B to G refers to which schedule have you offered this income. So there's a clear linkage of your income tax return, the rest of the return with the schedule FA, versus table A1 to A4, there's no linking of it, does not ask you to where have you offered it in the return. So therefore, possible view is that A1 to A4 is something that is more often that is going to come from the financial institution. There, you need to go with what is the interest credited in the account, irrespective of whether you are offering it in your return, because obviously there's a legal reason why you're not offering it in your return, because you're not earning that interest. But therefore, in such situations, a view could be that you need to disclose the interest, even person B will need to disclose the interest received in such kind.
Sorry, just to add, A1 to A4 schedules are like very identical to the Strata CRF reporting tables, which actually come as an online exchange, automatic exchange of information to the Indian government. And therefore, it's always better to report, because anyways that same data is going to flow to the department FAIU unit. And when they sit to compare, if they see the asset, they don't see the gross interest received, probably they might send you a letter and you might be able to explain it. But if you have already reported that gross receipts, the letter may not come to you, so you can avoid any correspondence with the department.
Kartik, you have an experience of a nominee shareholder, or it
It was
was
not a life insurance policy, which is actually the next question that I'll take it up. The next question is whether nomination in foreign person's life insurance policy needs to be disclosed. Now, nominee is strictly a custodian. Nominee is neither a legal owner nor a beneficial owner, and therefore nominee may not be required to report. Out of abundant conservatism and caution, you want to report, you can always go and report it to avoid any notices. But a beneficiary of a life insurance policy has to report it. However, we've had a practical case where there was a non-resident who had taken a life insurance policy when he was outside India. His wife was named as a beneficiary. They came back to India for good. And after they came back to India, husband has been constantly reporting the premium paid as a foreign asset. All the premium paid as foreign asset. However, we got a notice for his wife who was not filing a tax return in India because she was not otherwise liable to file a tax return, and therefore she had not reported the beneficial interest or beneficiary interest in the life insurance policy. We made an explanation, gave the copy of the return of the husband that it's appropriately disclosed, and the case was dropped by the FAIU unit itself. It didn't go further. I believe very technically, the way the law reads, even a beneficiary needs to be reported. But like I said, you will get a notice on explanation, probably either if the officer is understanding, then he will drop it at that level. Otherwise, you will have to travel to it, like some of the other cases are doing.
So just one point, I think on the insurance, this thing, I think table A3, which refers to table A4, refers to insurance. If you see the guidance note on FATCA, of course, there it clearly states that what is not covered in this insurance is your normal term life insurance. It only sort of covers your insurance, which are sort of investment products, which are guised as insurance. So your annuity contracts, etc., which are insurance products, or which are in the form of insurance products, which are effectively investments. And those are the ones which are need to be disclosed in table A4, and not your term life insurance.
This person right at HGF, don't mind. These are individual. They're talking all about individual cases.
So I think most of the case, so FA schedule applies across, whether it is individuals, HUF, even companies, right? So I think most of, we are giving the examples of individuals, but it applies even, so yeah, even applies to HUF, so there is no, distinction between the same.
Exchange of information, I think, not coming for HUF, because other countries are not.
Yeah, correct. So legally, it is not considered as an HUF, it will be in the name of the Karta. So Karta would need to disclose at least that the asset is there, because what will happen is practically the information that is received from the tax department would be in the name of the Karta. And therefore, as long as you have disclosed it, possibly you may, get, not need to explain it. But while that's the way, because legally it is the Karta, they would not be recognizing the issue. In fact, I read this category. Outside India, no one understands HUF. But in US, I heard tax attorneys and everyone takes HUF as a trust. They treat it as a trust, that it is a family thing, right? Whether there is a karta concept, right? Of course, it's a fluid thing, but just how they understand it. And this might be, that's why they might report it, on the name of karta and how it is, but it's very difficult for them to understand as a HUF.
But this is applicable even for the account in gift city.
That's the next section.
Next question.
Yeah, you can answer.
Only on this HUF portion, I think, even for corporate entities and for some of the bank accounts, where they ask for UBO details, there is a possibility that the information may come in the name of the UBO, not in the name of the direct owner or direct owner of the bank accounts or the financial accounts. So it's better if as a UBO we disclose it, but as a beneficial owner, or as a legal owner also you disclose. So it may be something more than what CR under podcast CRS they are reporting. But if you are satisfying the condition of either being a beneficial owner or legal owner, it is always advisable, or it is always required to, you are always required to follow the FA schedule reporting. Next question is actually whether investment made in gift city to be disclosed. Gift city is a foreign jurisdiction as far as FEMA is concerned. From an income tax perspective, it is very well within India. And therefore, an asset located within the gift city, if you have made an investment in a gift city or holding shares or any other asset within the gift city or a bank account in a gift city, for a resident, that is not required to be reported from a tax perspective. I think we have less time now, and I think we are going to cover the non-disclosure part and the implications of the same. Some more few, basic questions, and I would like to jump directly for the ones which would be very common. Then what happens, how should we adopt the exchange rates? What is the cost and how the peak value is, ascertained? What is official store website policy? What if, and this is something which I will ask Ludwig if you can, take this up. What if I take it from xe.com? What if I take it from exchangerate.com? Because it is next to impossible for every CFO to get SBI daily buying rate for each day. Okay. Also, it will be, you can take this also here afterwards. The difference between the calendar year and the financial year. Right, and then of course Kartik and Mehta. So these are the two major important points which need to be discussed. And yeah, so good.
At the same time, we say we are short of time. So
Yeah.
I'll try to cover in succinct manner, but the fact of the matter is that yes, there is a requirement to disclose your foreign assets. Your foreign assets invariably, in most cases, would have been invested out of foreign currencies. The department wants you to disclose it in INR. For God knows what reason, they could have just put a drop down of the currency and you could have disclosed it in the exact same currency in which you have invested that asset. But no, they want you to do this painful task of converting that asset into an INR terms and then go ahead and disclose that into the FA schedule. I wonder how the foreign countries are doing it. So whatever data they are getting, India is actually converting it into INR and then comparing, okay, yes, now there is no matching. And we have got recently notices whereby they are asking, okay, we have got so much amount disclosed and you have got so much amount. You have disclosed X, meaning they have got X information and you have disclosed Y information. We had to point out that we had to hunt for them that, okay, what probably Forex rate you have utilized, because we have utilized so much of Forex rate. And finally, at least that was accepted. But the fact remains that the instructions to the form, they cover the fact that the rate of exchange for conversion has to be the telegraphic transfer buying rate of the foreign currency as on the date of peak balance. Then they have further defined that for the purpose of this schedule, calligraphic transfer by rate is the exchange rate which is adopted by the State Bank of India. So this is what is there even under the rules when it comes to the conversion of foreign income. The same is what you have to adopt as far as the conversion of the foreign asset goes. The fact is that in most cases you will not have it handy. There are certain blogs which are carrying, but they are not authentic sources. So what do you do? For example, the client has turned a resident today and he has a foreign asset which has been purchased in 2010. It's invariably impossible for you to go and hunt for that particular rate because we have to disclose a foreign asset at cost. So now, if you are trying to do it at cost and you are not able to get that rate, I would probably put it at FDI rates which are available as a public database or something which can be adopted. The prima facie objective, as we have discussed earlier also, is the disclosure of the foreign asset. As far as you have disclosed it and you disclosed it at a particular X rate or a Y rate, I don't think it should matter as long as you are not going, horribly wrong as far as the exchange rate is concerned. Otherwise, we have had experiences where we have explained to the officer. Unfortunately, the problem is that the foreign asset intelligence unit itself also is getting the converted amount when it comes to their, data. So it is not like they are adopting a forex rate, therefore they are able to say that okay, fine, you are adopted, so you have adopted. No, we had to hunt for it. We had to find out. In fact, the latest notices which we have received, they have in fact, issued it for 3 years. And in the third year, they have copied data for the second year and they have done a full jumbling now. And we are hunting here. What is this conversion rate coming from? What is this? And finally, we realize this is just a copy paste from the earlier years and there's been a mistake made. So from that angle, you have to be careful to see to it that what rate you have adopted. Please put an explanatory note. Don't just fill up the FA schedule in the tax return form and leave it at that. Unfortunately, the FA schedule does not cover the column for forex rate which you adopted, the date of the forex rate, the source of the forex rate. So what we are adopting as a practice is that okay, whatever has been disclosed in the FA schedule, we are also putting it as a note to the tax return and saying that yes, this is what has been disclosed, but for so and so asset we adopted so and so rate, which is this is the source and this is the rate date for which the rate has been adopted.
Writing note is possible.
No, I'm sorry, I'm not on the online ITR form. I'm saying that it is for your own records and for the client's records. I'm sorry, I should be clarifying that this is the system which we are adopting for the record keeping within the firm and for the client. The queries will come 2, 3. In fact, we are getting queries for assets which are held even a decade back. So that is where these notes will become very useful. That okay, yes, this is the source adopted and this is the date for which the rate is adopted. Is that covering the query? I think other one was on financial year. Okay, so calendar year versus financial year. I think as far as possible now, at least for EY 23-24, the department has come up with the ITR form, adopting of the period for which the disclosure is required. So in the table title itself, if you look at tables A to G, the table title itself says that at any time during the calendar year ending as of 31st December 2022. Before this, that was not a requirement. A couple of years back, it was okay during the relevant period. So what was the relevant period? Then you used to go to the IT and instructions. They would say that okay, adopt the financial year which you are adopting in the foreign jurisdiction. Before that, there was no clarity at all. So people used to report from April to March. We have done that. So they kept on changing the stance. Because probably the reason is they are getting data as of December end now. So they don't want to take the effort. They are saying you take the effort and please now find out that what is the December end holding that you have of the assets. We have had to keep on changing the requirements for our clients, and the clients are also saying, what is this going on? One you are asking me financial year, next you are asking calendar. I am saying that I am not doing it, the form is asking for it. Now the form at least now says that you have to disclose as per the December holding. As far as December holding goes, you will disclose it. Fine. The fact comes that you have from tables B onwards the requirement of disclosing the income from that asset and the schedule in which that is reported. How do you disclose income? Not on calendar basis because you are disclosing income financial year basis. So then you are again coming back to that the asset is disclosed as of December end. The income is disclosed for the financial year concept. Because you are matching everything. You are matching the asset as what their data is getting. You are matching the income to the schedule which you are offering to tax. So these are the two elements. The principal elements, as I think one of the underlying principles which we covered in the Hardik covered in second slide was the fact that you try to match it. And wherever you are not able to match it, you explain. Again, a note for your own record, for the client's record, stating that yes, you have disclosed as a financial end, and this is the reason why you have disclosed it in such a manner. There are stray cases, there are outlier cases where you have a case where you have purchased the asset between January 23 to March 23. Okay, you have earned income, so your income will be offered to tax. The asset value will be disclosed because they are asking that assets only to be disclosed as of December end, right? So you have an income and you don't have a foreign asset disclosure. Go to table G of the foreign asset schedule where they are saying that income which is earned outside India, which has not been disclosed in table A2, at least disclose the foreign income and put an explanation that yes, foreign asset could not be disclosed because you asked for December end. God knows tomorrow they will get some data and then they will again ask you that okay, why is this not important? So at least you have a defense to say that no, this was purchased after December, right? And therefore the asset has not been disclosed, the income has correctly been disclosed. Sorry, anything to add?
No, just one point. I think again, adding to that mismatch, the requirement under section 139, which says that no, if you don't have any income exceeding the maximum amount not chargeable to tax, it says if you have any foreign asset, if you are beneficiary owner or beneficiary of a foreign asset during the previous year. So so there again, the requirement for you to file the return is if you are holding it during the previous year. Again, if you go in the income tax return also, in your part B DTI schedule, it asks you, do you hold any, do you have any foreign income, do you have any foreign assets, do you have a foreign, signing authority during the previous year, and then you can fill up schedule F. So there can be situations where you say you take yes, you have foreign income in the previous year or foreign assets in the previous year. You go to schedule FA, but you don't feel anything in schedule FA because it's not during the campaign.
Then that throws an error. That throws an error in processing because you're disclosing that you have a foreign asset, but you're not disclosing the foreign asset. So as might as well then disclose it appropriately at least one of the tables. Again, this is not that your disclosure in FA schedule is going to be held against you. That okay, why did you disclose more, or why did you disclose X against Y? I think primarily the idea is that you disclose so that you are able to match the data what they are receiving from abroad.
Before we proceed, and we have 20 minutes to go, there are a lot of basic questions which we can know. We can have Q&A from the participants, or we can create the case studies. So, no, we answered case studies.
Give schedule again.
So we can take Q&A. Just last one question, and then we can open for Q&A. And if permitting, we'll go back to case studies. Okay. Now, just to add, when he says that income, right? We are not discussing foreign income and everything, but
case studies are the little bit better. Each case study is better. Maybe some question will already be answered. It will be better.
Okay. So, just to add, there is also schedule. In this schedule, it is covered. I think long back, exempt income was not, visible, but now I think they have dropped down. And even if your income is exempt of that foreign asset, the foreign asset has to be disclosed, and even the income has to be disclosed. And you have to write the relevant schedule for the same. Now, I think most of this have already been answered. We move to the case study. I would like to, ask Mahesh to just give, and this is where I think this is a common thing, bank accounts, right? And custodial accounts, depository accounts. In very briefly, you can just, explain where bank accounts has to be disclosed and what has to be disclosed and what demands or, many times depository, we understand, depository, that means, demand account. It's not like that. So I think, Mahesh.
So yes, so I think again, depository account, custodial account, these are not something that one comes across or any language in the Income Tax Act, nor in the instructions is there anything given. So one tries to see where is this language coming from. Again, Kartik alluded to that table A1 to A4 is coming picked up straight away from FATCA. So one tries to see why is there a different context of reporting as a financial institution, given that that same information is going to be received by the tax authorities. One tries to see if you can take some sort of guidance from there. And so depository accounts, I think clearly covers your bank accounts. So your explanation to Rule 114F covers what is depository account is basically your commercial checking, savings, time account or thrift account. Again, if you see the guidance note to FATCA, it sort of covers your savings bank account, commercial bank account, or loan association or credit unions. Interestingly, even e-wallets are covered in your in this CBDT circular of 2015. where in question 22 they have given a response saying that even e-wallet is similar to a bank account. So therefore, depository accounts is a bank account. And again, going back slightly, when FX schedule first came in, you did not have A1 to A4. You had only table. So if you see how FX schedule is, table A to Z was always there, but table A was only one. It was foreign bank accounts. So that continues now except that with foreign bank account there are other things that also need to be disclosed. So you have your foreign bank account which would be disclosed typically in your depository account. Then you go to table A2, which talks about your foreign custodial accounts. Now, what is foreign custodial accounts? Are basically your overseas brokerage accounts. A custodial is again, if you see the rule 114F, a custodial and as well as the guidance note, a custodial is someone who's holding investments or in your name. So therefore, typically your overseas brokerage accounts, etc., or even your PMS accounts would get covered in foreign custodial accounts during the year. Then coming to A3, you have the details of foreign equity and debt interest held in any entity during the year. Now, what is that? Again, if you go back to guidance note on FATCA, the examples that it is sort of trying to give is sort of these selective investments. You have mutual fund units, you have your PE funds. So all those, where there are collectively the investments made and you are holding the units in those would typically get covered in A3. And you have your details of foreign cash value insurance contract or annuity insurance. So which again, we discussed that those investment products which are sort of in the form of insurance policies, those would typically get covered in A4.
Yeah. So I think before moving to the next case study, which is on ESOP, we can first complete the questions from the audience, and then we can, yeah, please.
So which has a code block. So who is the beneficial or where
I think we had one of the holding structure case study, right? But I think we can take it right away. I think let's take it. Yeah.
Yeah, so this is, outbound investments, and outbound investments, frankly speaking, there could be, finally individuals, promoters who are having an Indian company having an overseas subsidiary. Overseas subsidiary has some assets. How far do you go down the chain, right? So I think that's what your query is, that the subsidiary has a full block, or probably the subsidiary has another subsidiary downstream, and that probably has some full block. So how far do you go ahead and report? Our understanding has been that as far as the Indian company is concerned, it's also required to file a foreign asset declaration. Now, when it discloses the foreign assets, what it will disclose? Prima facie, first and foremost, yes, what it covers in its balance sheet as foreign investments, definitely it will have to disclose those. Now, for the fact that whether there should be underlying disclosure also or not is where there is divided opinion, probably even on this panel. So as far as the disclosure underlying goes, the fact remains is that, okay, fine, how do you disclose that? Because you are asset, the company here, the company Exco has YCO as its asset. So it has given the disclosure there and Mehta ends there. Now, if YCO has to disclose ZCO or not is where the question remains. The department's view at a particular point of time was that yes, you need to disclose underlying assets also, because the fact was that they are getting the data from those institutions which are holding such bank accounts. They are saying that, okay, fine, as far as we are getting the information, and if you do not disclose, we will consider it as a fact that you have not disclosed the foreign asset. Seems a bit unfair, but that's the fact of the matter, and therefore it's better to always say that the underlying asset, whichever is there in your control, and where the beneficial ownership remains with Exco, it may be prudent to disclose those assets, because that is where, again, I am reiterating, disclosures is not equivalent to your balance sheet. You please may not worry about the fact that, okay, tomorrow there will be duplication, right? Exco will disclose YCO, it already discloses YCO at say, whatever, $1 lakh. Then YCO has ZCO investment of say $80,000. So you are technically disclosing not just $1 lakh, you're disclosing $80,000 also, which means you're inflating your net worth, it seems. But no, they are not computing the total of that foreign asset or schedule FA to say that, oh, you have so many assets. No, that is not what's happening. They're trying to match what they're receiving from abroad with what you're disclosing here. So in that sense, it could be good to disclose the fact remains is that you do not own that asset as a legal owner. You probably may become a beneficial owner, which brings to the question of what Mr. A and Mr. B should do. The fact is that when we have inquired our clients have said that yes, as ultimate beneficial owners, we are providing our passport to the bank account for YO, to the bank account for even ZCO in quite a few cases, because they are acting as ultimate beneficial owners. So in that sense, Mr. A and Mr. B, while they will not report tax, so obviously it's an Indian company, they will not go for that. They don't have any foreign assets. You will notice in this example, Mr. A and Mr. B do not hold any foreign assets, but they are ultimate beneficial owners of YCO and ZCO's bank accounts. Whether they should disclose or not, again, in my view, it's prudent to disclose because their data is coming to the department. The department is questioning with specific queries that yes, you have interest in a foreign financial interest in a foreign entity with the name, with the particular country in which it is, which it is incorporated. If that data is coming to the promoter of the Indian company, then you can imagine that what data they are getting. So it's better to be prudent in that sense to disclose and explain that it is not my asset, it is my Indian company's asset which is being disclosed.
Just to add on what his query was, what if for a listed company? And I think this is where I have just a different opinion, right? And of course, we all have our views. He was right now saying from the perspective of A and B, which I agree because UBOs you mentioned, but from perspective of a listed company, and I think none of us have tested it, some of you, we don't know how many line items are there. So can you ask Reliance Industries to write all the subsidiaries and step down subsidiaries in their FA schedule? And then I'm just then you can ask Mukesh Ambani to write all those things in his return of this. Absolutely not making any sense. So that's where I feel one should draw line. But yet, on the safer side, to avoid any absurd thing because it is 10x per thing, you can just add and you can make a remark. But yeah, this is what I think that gentleman wants.
I don't think I'm good enough to advise Mr. Ambani here, but only fact of the matter is that we have disclosed it for our clients who are holding through their personal holding companies a series of assets downstream. And that has gone as what Hardik pointed out, it is a 300 line disclosure in the foreign asset. And still we are doing it year on year, but till date at least we have not received any notice. Now, how far that proves the fact whether we should or should not, the fact remains is that the disclosure doesn't matter. As long as they are getting data, we should be able to be matching that. That's all.
Also, just one point, I think when the listed company is holding subsidiaries and set-out subsidiaries definitely should not get covered. Because if you see the definition of beneficial owner, it talks about an individual. So if you see explanation 4 also, for the purpose of the section, beneficial owner in respect of an asset means an individual who has provided directly or indirectly. So a company cannot be considered a beneficial owner under the act as well as even under the instructions for the purpose of the reporting under Schedule FA. So therefore, step down subsidiaries will not be disclosed in the Schedule FA of the company. Of the individuals, again, multiple views, and I think conservative is obviously to disclose it, but at what end, and that's obviously going to be there.
I'm looking good more elaboration. See, what I'm visualizing is a listed company having only owned subsidiary private limited company in India. That private limited company has made another company which has cold block and which is making a huge losses also. So because of the CFS requirement, listed company has to consolidate and publish all the results. So anyway, data is coming to the department. So now, as far as what I visualize, Indian subsidiary has to disclose. That's all, and that matter close.
That's correct. So you're saying foreign company having an Indian subsidiary and has again a subsidiary outside India. So direct owner.
Suppose a listed entity has because of some NPA or something like that, the bankers have taken up let's say 70-80% of the shares. Now, no individual is having more than 10% shares. So who will be UBO in this?
I think that is where I think
FA schedule reporting is irrespective of what percentage you are holding. The information from overseas country may come in if you are a UBO based on the FATCA CRS requirement. I think 10% or 25%, depending upon what the guideline is. But you still have to report even if you're holding one share of a foreign company. There is no exemption. It does not say you need to have a control or you need to be. If it says legal owner or beneficial owner, legal owner owning one share also, you have to make a report.
But in this case, will there be any review?
UBO concept, sorry, UBO for KYC again is different, for Patta reporting is different, there are different criteria under both the guidelines.
Somewhere where 10% limit is taken.
That's anything under the KYC norms. When you open a bank account, they will ask for a KYC detail of a UBO which is 10%. I think the Patta CRS is 25%, right?
So nobody knows 10%.
That's not the information may not flow automatically. Information may not flow automatically, but that does not absolve from reporting the foreign exchange.
Sorry, your situation is not that the bank is the owner. Bank has seized those assets as a
Correct,
right? So the owner still remains the shareholder. Yeah, the fact what is happening in the NPA process is different from the fact that about disclosures. So I would not suggest to go to that extent about UBO. The fact is that yes, if the person owned and then the assets have been seized, the fact still remains that the disclosure is still required.
So one of the is the UBO is
I think we can take because it's quite
So just one point in this example, when we're talking about, Mr. A, whether he needs to disclose investments in, when he has invested in Exco and which is investing in Vico, whether he needs to disclose, investment in Vico and in Schedule FA. There's a Jaipur IT in the case of Krishnadas Agarwal. There also it was similar fact, except that, it was not maybe Vico investment, it was, Indian individual had invested in a foreign company. Foreign company had obviously bank accounts with an operational foreign company. And now in that, when they opened the foreign bank account, being the individual shareholder, he had given his passport and his details. So that was being reported. And there the question came up, well, where is the beneficial owner of the asset, etc. And there I think the ITAT took a view saying that the Indian individual has disclosed the investment in the foreign company. Now, it cannot be expected, an individual cannot be expected to go beyond that, that when you go into assets held by the foreign company, those also be disclosed individually. So that need not be, so long as it's disclosed the investment in the foreign company, the investment or the assets held by the foreign company will not be disclosed. So similarly, possibly one can consider, but again, that is in the case of litigation. As a, when you are going and advising the client to disclose, obviously, one would try to take a conservative view as to the extent possible. But for litigation, there are two decisions which state that beneficial owner is, that when you have directly provided the consultation, indirectly is to somebody else. But not when you are investing in one company, which is investing in another company, which is investing in another company, you keep on disclosing the step down subsidiaries to that extent. But again, like I said, it's a disclosure versus litigation point.
Sorry, one small complication if I were to add in this example, instead of A and B, if there was a private family trust, like be it discretionary or a specific trust, really speaking, how do you really do the reporting? And I think from a FATCA CRS perspective, what they look at is in case of a discretionary trust, they'll be looking at the trustees. And from a specific trust perspective, they'll be looking at the beneficiaries. So that's how probably the reporting also should happen.
Any other questions?
Any individual, if he purchases from his domestic demat account, the share of Nasdaq listed, so he has to report that also. Share is coming in the domestic demat account.
So here, let me ask, to Mahesh, So, in fact, yesterday, I had this discussion. So, like I told when you started this, they have a concept for FBAR. We have FA schedule, we have a concept of FBAR, which was much before FA schedule. It is a similar thing. And that is where sometimes when you have foreign broker accounts or foreign mutual funds or foreign demat accounts, let's assume you have 300 scripts in a demat account. Generally, a view is taken if I give a demat account number, it should be enough because demat account covers it. What does that apply to India also? Because India has a specific format. Now, if I have a sort of PMS or something, it's a proper broker account, it's a demat account, and I have purchased 100 scripts of Nasdaq. Do I have to make 100 entries? I can just write the demat account number with the, if I am able to have maximum balance also,
and blah, blah, blah. Is it okay? Yeah, so I think, so if you ask me from a litigation perspective, I think, so long as you have disclosed all of it combined in one, also it should suffice, because the idea is you have disclosed the assets of them. Again, where in the head of ADCA, foreign companies themselves are not going to be reporting the investments, right? Or their shareholders. What is going to come reporting in this FATCA CRS exchange of information is the financial institution. So the broker, he will be reporting these investments in the to various tax authorities, and then it will come by exchange of information to Indian tax authorities. So therefore, if you have disclosed, so long as you have disclosed consolidated in one, possibly a view can be taken that yes, it need not be disclosed again. But again, again, multiple views. If you look at the other side, that you have to disclose the bank brokerage account as one, and then disclose individual assets in your table B or individual investments in table B as well.
Yeah. Questions?
How many years back the notice can be issued for the non-disclosure of
10 years now. I think that has been.
Have you no income? For non-disclosure of foreign asset, there is no specific time limit.
It goes by, earlier I think it was at 16 with regard to foreign assets and income, right?
That was even 140. 140 for international assets. No, for section 43 black money, there is no time limit.
Yeah. So we can take the ESOP case study. It is itself is a topic itself. Yeah.
So I think quickly try and answer the relevant implications. Here is a case where there is A Inc., which is an overseas company, which has a subsidiary in India, a private limited, and it has an employee obviously in India, and that employee is being offered ESOPs of A Inc., which is an overseas entity. So Indian employee who is resident and ordinary resident has been offered ESOPs of a foreign company, and how does the reporting work for this Indian employee in his tax returns from a foreign asset perspective? So when the grant is made to this employee, you simply you become a part of the scheme and you get a grant letter. What is it that the employee is holding? Just a hope, nothing else. Correct? And therefore, he needs to complete the vesting vesting conditions, and after that, he becomes eligible to an exercise. And from that perspective, he does not have to make any reporting at the grant stage. There could be some very stray cases where even for a grant, you are to make some remittance or payment, maybe a nominal amount to be a part of the scheme. If you are doing that, in that case, yes, it is advisable to report whatever amount you are paying, because that becomes your investment. And you should report that in the foreign. But very stray cases, I have not come across any cases, but I read some articles of some foreign countries where ESOP schemes had this provision, and therefore I thought I'll mention that. Practically, I have not come across a case where for being ESOP being granted to you, you are making a payment. Therefore, in normal cases, no reporting at the grant stage. When you come to the during the vesting stage, situation remains the same. But once that you complete the vesting condition, correct, you have eligibility to exercise the ESOP, and therefore you have a right to get a share at a future date, which is your decision to do it or to not do it. Once the ESOP vests to you, you have a right. There is an asset, which is a right to acquire a share, and our capital asset definition also covers something similar. And therefore, there is a foreign asset that you are holding. You have to report it in the FA schedule. Which table? Probably table B or table D is a play, correct? But as long as you report it at either places, it's perfectly fine, correct? What value? Because you've not paid anything, so you report value as 0. That's perfectly fine, but the reporting has to happen. And so there could be a possible view there that an employee want to take. I would not want to take that when I'm actually filing the return. But if I'm not reported by any chance, and there is a notice, a view which an employee can take as an argument in front of the court is that even though if it is a right which I have, to get a share in future, but I have not accepted it. I will accept it when I actually exercise the option. And therefore the contract is not complete, and therefore the asset is not something which I own today. I will own that asset only when I accept the right, when I actually exercise the option. That could be an argument which you can take in the litigation, but if you're actually filing a return, then please disclose the option. That's the advice. And then once you complete the exercise, you actually are allotted a share. And in that case, you have to start reporting that. And in table B, where you report a share in a foreign entity. What happens in case of other similar schemes, in case of ESPS or ESPP or directly allotted shares? So yes, you start reporting the day you are allotted the shares. In case of RSUs or PSO, these are basically pure incentive plans, very similar to a bonus. You don't own any asset. You just have a right to get some bonus or an incentive which is quantified based on the appreciation in the share price or happening of certain events in the company. Correct? And that is akin to a bonus letter that you receive, which is not an asset. It's just a promise to get a current income at a future date. And therefore, RSUs or PSO, which are more akin to a bonus letter, are not required to be reported in foreign asset schedule. Obviously, when you receive them, you will report it in the foreign FSI and as an income and as a taxable income if you are a resident and ordinary resident at that point in time. Anything that panelists want to
Thanks, Kartik. Just to add here, I think we had to skip that question. This is like we explained the rights, even in case of subscriber to MOA, right? And I think one of you can either give your comments. In my view, subscriber to MOA might not be an asset itself, but it has to be reported because you have a financial obligation and kind of and we were just discussing before the session. Under FEMA, can you know without sending the money start business and blah blah. But for all said and done, when you are subscriber to MOA, you are the only owner of that. Tomorrow if something happens, who is the one going to get the happiness? So for such case, it has to be reported. If any other comments, okay. Just to summarize, I think we are already past our time.
Sir, can you elaborate RSU little more?
So my understanding is RSUs are similar to basically it does not allow you. There could be an option to get shares in future. That will be the case.
Let us say 10,000 RSU is allotted.
Correct.
Out of which let us say 40% tax is deducted by way of purposes.
Correct.
Rest of the shares are allotted to the.
So that being the scheme, then you are actually getting shares. Then it's based on. Correct. And you have to report it like ESOP.
Any capital gain overseas.
You have to report it.
We have to report.
Absolutely. But if it's only you are only going to get appreciation. Sorry.
Yeah,
gross.
And then you get it. So to let us say out of 10,000, 4,000 goes towards the income tax. Okay, 6,000 is allotted in the name of the sales, and balance will be the purpose or whatever you say.
See, what happens is that 10,000 are allotted. That is the reason why it's a taxpayer's income. Because it is chargeable tax on capital gain, so they are deducting 40% out of it as a tax deducted at source, and therefore they are selling off those 4,000, and therefore you are getting in hand 6,000. The fact is that 10,000 was your holding, 4,000 was sold off, which is essentially capital gain. No, agreed, but the disclosure goes for 10,000, against which you will show the capital gain which is made on sale of the 4,000 units, which are filed for payment of tax. But the fact remains that all those transactions will have to be reported, and your reported foreign asset will be 10,000. The final holding will be 6,000. That's the condition. Because they are saying that, and that's a very important point, holding at any time during the year. Even if by the end of December 22 you have sold off the asset, doesn't mean you don't disclose it. You disclose it, and therefore you have to then explain that that asset is no longer held because the capital gain against it has been offered to tax.
I hear another peculiar place may not be FA, exporter company has opened a bank account with Standard Chartered Bank in Mumbai, and that account is operated in euro only. So, so all coming in euro, year and balance also remain in euro. So whether it is considered as foreign asset, yes, not considered. It's bank for normal bank. So I think with that, let's wrap up today's session. Of course, we have a lot of things we could have discussed, a lot of hybrid instruments for which I think next, with a suggestion, you can have a taxation hybrid instruments like safe notes, phantom shares and everything. So I think that can be discussed in such session. But the summary of today's session, when in doubt, report it. So I think you will save a lot of money for your client also and a lot of litigation for you also. Tomorrow, you won't have anything. And second, I always tell them jokingly, they are Brahma, Vishnu, and Mahesh of our foreign assets who have beautifully summarized today's questions and case studies. Thanks everyone.
I would thank you all four of you for having this wonderful discussion on foreign. The name is very small, but I think it involves a lot of things and needs a lot of discussion. And this time looks like it was short for the topic. But nevertheless, before we propose the formal vote of thanks, I would request you all. We have a lucky draw. This is our okay. After the vote of thanks. So first, for the vote of thanks, I would like to invite CM Avi Jain, who is also a past candidate.
Thank you, friends. The topic was to reporting foreign asset in ITR. I think the name seems very simple before we heard this panel discussion, and even most of our minds is that yeah, is just reporting what asset we have, and that's all. But when we taken the gain from all these, and our moderator, Mr. Hardik Mehta, has taken all their experience very much, and we listen all them. It seems that no, it is very much serious. So we have to take very, we can say very seriously. So otherwise you may get notice, or that notice itself is of 10 lakhs, not more or not less, maybe more, I think, but at least it's 10 lakhs. So for this is the new things for one disclosure is 10 lakhs. So as per our knowledge, we have taken means a student has gone abroad for study. He has opened current account or saving account, whatever there. And after coming India, he has forget to close the account. There is no transaction, nothing else, but that account remain there. And I think in general, we are not disclosing them. So if 10 lakhs notice comes, no, from tomorrow, we have to take care. Anyway, friend, all panelists have given all the questions, their answers, their elaboration, and we have taken all the things in very lucid way. Mr. Hardik Mehta also taken all their experience, and Hardik, and it's just like taking the juice from the fruits, and we have enjoy all the things. So let us give them a lot of louder. We can louder. They have also, I think, explained all the queries, and I don't think any query remains, at least not mine. Yes. Thank you. Thank you. Wait for 2 minutes. Let's wait for 2 minutes. There is a lucky draw. Maybe your name also appear. If it will not be there, you may lose the winning.
There is a announcement that breakfast is served in the adjoining hall, it's not served outside.